It's great to hear about short-term rentals, which is something that I've wanted to do with some properties that I have, and I didn't have any of the details that these guys provided tonight, so it was great to hear more about short-term rentals. For those who don't know what cost segregation is, it's the IRS-approved methodology for accelerating depreciation, and what that does for people is allow them to accelerate depreciation and reduce their income taxes. So we're going to cover that quickly tonight. This is something I've been doing since 1999. That's my contact information, blah, blah, blah. So we typically work with CPAs. CPAs are typically who call us to their clients, whether the client is buying a Dunkin' Donuts location or a big office building. We do everything from really small stuff to really, really big properties. We do them all over the country. As I say, we work with about 300 CPA firms. Down. So we've been doing it, the firm's been doing it since 96. I've been involved since 99. There are other things that touch into cost segregation, which are tangible property regulations, which allow you to take write-offs on things when you do renovations of a property. So when you renovate, you can take write-offs at that point for the stuff that goes in the dumpster. 179D is for commercial property that you're trying to take advantage of the tax code and energy efficiency upgrades that you do to a building. That's for commercial property. That's $1.80 per square foot is what that's about. And 45L is for residential. You get a $2,000 per unit tax credit. We do those as well. And de minimis studies allow you to take write-offs on any item that you bought for $2,500 or less, and you can immediately expense that so you don't have to put it onto the depreciation schedule. So we've done about 20,000 studies since 96. We do them all over the country. What we're trying to give you folks as real estate investors and advisors, for those that are the agents and brokers out there, we're trying to help you have a tool in your toolbox for understanding and helping your clients or helping yourself if you're your own investor type person. Cash is the king in our mind, so if you can retain cash and you don't have to send it down to Washington, D.C., it's better for you because then you can redeploy that money and either buy the next property or improve your current property without having to take loans, which is cash is king there. So that's kind of our little thing there. It is the IRS approved methodology for accelerating depreciation. Instead of writing everything off over 27 and a half years, you can move pieces of what you bought into 5, 7, and 15 years. And in doing that, you get to take the same amount of depreciation ultimately. You're taking it sooner, reduces your income tax now, and with the Tax Cuts and Jobs Act of 2017, you get to take the 5, 7, and 15 year all in the first year if you want to. And I'll probably jump over stuff that's too CPA centric. In other words, I'm going to keep it on the upper level of the conversation. If you want to drill down and ask me questions about details of the tax code, I can get into it, but it's probably not going to be the audience for that. Although Tony's going to try and throw me curveballs here.
I right now have no idea what you're talking about.
We'll see in a moment. So,
you're already over my head.
So the reason this is important, and the reason that a lot of people don't use it, is that the rules are very complex, and most even accountants don't understand unless they're real estate focused CPAs. So you have to have qualified professionals do the work. In other words, CPAs, just because they're a CPA, are, for the IRS, are not allowed to just say, oh, well, that wall is load bearing and that wall isn't load bearing. Down. And so bottom line is you need to have qualified professionals do the work, and that's the group that I work with. We're going to assume here, I laugh at this, I work with 6 CPAs and 17 engineers. And so they write this and they say taxpayer. They could have said the client, they could have said anything, the buyer. No, they call it taxpayer. So taxpayer, because a lot of these presentations are for CPAs. But this person has bought a 4-unit, single structure, multifamily for $400,000 that's already got land subbed out of it because land is non-depreciable. So let's assume that the client bought $500,000. We had to call $100,000 land non-depreciable, and this is a 2021 purchase. So here's the scenario. So what we have here is $400,000 purchase price right up here. And I don't think the bubbles work on this because I think this is now a PDF. Okay, yeah, they don't, so I'm gonna go back to it. So 400 grand would give the client first year about $7,800 of depreciation if they did nothing else. Thereafter, under straight line depreciation, which is what you'll automatically get if you don't do anything else, the IRS will say, okay, whatever you paid for the building divided by 27.5, your depreciation thereafter is $14,544. This is the before snapshot. Afterward, after we get done, we've moved in what the IRS will allow you to take earlier. We've moved 48 grand, or it looks like 12% into 5-year life, 36 grand into 15-year life, which is about 9%. So we've reallocated here 21% of what you paid for the building. Of that 400 grand, 21% is now eligible to be accelerated. Okay? So the client would have gotten $7,800 if they did nothing, but with the cost seg in hand, they're going to get to take $70,000 the first year, which is going to create, let's see here, about a $32,000 tax benefit. So this is the change in appreciation they got. Their tax benefit the first year is 32 grand of tax deferral. So that just saved them on that 400 grand, about 8% of their overall purchase price. So now we're going to step it up a little bit. We're going to go to a little bit bigger. Maybe it's a multifamily. Maybe it's in Somerville or Cambridge or Waltham, you know, a bigger family type situation. 1.2 mil. And this was purchased in 2016. Okay, so in 2016, they paid 1.2 mil. Again, you had to sub out land, so the real purchase price of the overall parcel might have been 1.5. Let's assume it was. 1.2 is the depreciable basis. In 2016, they put it in straight line. So far, they've taken 198,000 of depreciation under straight line. Again, the before snapshot. They've taken 198K. But we come in and do the reallocation, 12% into 5-year life, 144 grand, 9% or 108 grand into 15-year life. And you say, okay, so what? Boring depreciation, what does that matter? Well, they've taken 198K, but the IRS would have allowed them to take 332,000. So they've shorted themselves in that case about 140 grand of depreciation. So they can take 140 grand of catch-up depreciation and they don't have to amend their tax return. So they can grab that depreciation in the first year that they do this study, and what that's going to do for them is end up helping them in the first year save about $56,000 of income tax. So on that one, they save 56 grand. Somehow on that formatting, it got jumbled there.
I PDF'd everything because I don't trust the Wi-Fi.
Okay.
And I screwed both of you guys tonight with your animations and your bubbles.
I know, the little bubbles are...
I'm sorry.
No problem. So, on this... Oh, yes. Okay, so anyway. So, now we're going to a bigger property. A taxpayer bought a bigger multifamily for $18 million, again, net of land. And so under this scenario, same thing. There's a bunch of stuff in your properties that are eligible for 5 and 15-year life. So in this case, 18 mil, the client would have been able to write off, well, first year they wrote off, it looks like 354,000 if they did nothing, but if thereafter they would get 654. But in this case, 5-year property was 2.8 mil, 15-year property 1 mil, and that ends up giving the client the depreciation pickup of 4.2 mil. And their change is this number here, 3.8. That's what the cost seg delivered them. And it saved them 1.55 million of income tax. Okay? So it's all about scale. The bigger the property, the more tax benefit that's in this for you. What we usually find is that if clients spend $1 for the study and they get back at least 5, it makes sense to do because they're getting 500% on their money. With that said, usually we hit that 5-to-1 ratio if you've spent more than $500,000 on a property. The reason we're here tonight is because Candor Realty wants you folks to learn stuff that you can use for yourselves and for your buyers so that you're a more educated provider out there or a more educated investor. And you can learn about these techniques, because oftentimes what you'll see once you're in the investment real estate space, you'll see transactions that when the person buys, the debt service is barely covered by the rents. They're just breaking even. Why would anybody buy that property for a very low cap rate? Because one of the moving parts is they're getting to take the accelerated depreciation, which gives them a tax break that doesn't show up when they're just paying out the rent. So it becomes a big tool that folks in the business of real estate investment play with all the time. So everybody always asks me, well, Jeff, what are the 5-year, what are the 15-year items? How does that all work? You know, what's going on with that? So that just killed my eye there, sorry. The IRS says a building to be a building has to have certain things. Walls, windows, doors, roof, HVAC, plumbing for a bathroom, electrical for lighting. Those are the items the IRS says are either 27.5 year for a multifamily or 39 year for anything else. So this building here is 39 years. Any building you see other than residential is 39. Residential is 27.5. So these are the areas or the items that are 39 or 27.5 years. This is a little photo representation of obviously HVAC, tile that you can't pull up quickly. Interior plumbing. The bathrooms are considered by the IRS to be essential. You got to have them so they're 39 or 27.5. Siding, because it's got to have the building sealed up. Roofing and foundation work. Here are the 15-year. People say, well, what's 15-year? I want to call everything 5-year. Why do you have anything 15? I don't want 15. Well, 15 is anything from the perimeter of the property line into the building. So it's exterior of the building. So it's going to be, everybody thinks, oh, parking lot. Well, yeah, but you've got fencing. You've got retaining ponds or drainage ditches. You've got signage. You've got lights out in the parking lot. You've got conduit that takes electric out to the parking lot lights. Paving, I mentioned. So there are a lot of items that go into 15-year. Swimming pools, if one of your properties had a swimming pool, 15 years. It's got decks outside. If it's got trees, planting beds, shrubs, all are 15 year. Here's some jazzy pictures of those. I mentioned all that stuff. And then the 5 and 7 year. So it's 5 or 7 year. It's 7 year if it's an office building. Or down. It's 5 year if it's residential apartments, if it's restaurants, or if it's retail. Otherwise, it's 7 year. So plumbing and electric. So plumbing in your bathrooms in the apartments, in the multifamilies that you have, plumbing in the bathrooms, 27.5 year. Plumbing in the kitchen, 5 year. Kitchen, so the millwork that's in the bathroom, 27.5 year. Millwork that's in the kitchen or the other living spaces is going to be 5 year. Carpet, removable flooring. So if you can pop up that engineered flooring surface fairly easily without it, bringing in a jackhammer, then you can call it 5 year. Decorative lighting. IRS says you have to have light in the room. So in this room, probably the primary lighting would be let's say the chandeliers. But then you've got secondary lighting. You've got the track lighting over there. Sometimes there would be hi-hat lighting. There would be sconces on the walls. So any of the secondary lighting you can put into the faster light. But not just the fixtures. The wiring back to the circuit breaker, and then from the circuit breaker to the transformer. You can claim that as 5 year. Trim and cabinetry. So the jazzy decorative kind of wall thing over there, the wood covering there, that goes into a faster life. You've got window treatments, you've got trim here on the floor, crown molding. This whole apparatus here is all 5-year stuff, and the wiring back. So now I've covered all of that. I'm trying to go quickly here. Oh, jazzy pictures. And I covered, so the fancy floor there, specialty electric and plumbing. So in an office space, if you had work, for like an employee break room, or a kitchen space for people to work at, that would go into a faster life. So where this is applicable is for if you're doing ground up construction. Okay, sometimes people and or CPAs go, oh yeah, that's easy to do because you've got the invoices. The problem is the invoices, if they come on an AIA document from a contractor, have probably a breakout of 16 to 25 line items. And we break that into about 1,000 different individual items. So that bottom line is, even with an AIA from a contractor, you're not going to get the breakout that you need to determine what was the millwork in the bathroom versus the millwork in the kitchen. So new buildings under construction make a lot of sense to do these for, because you can take bonus depreciation on them. Existing buildings, so if a building's been around for a long time and you're renovating it, you've owned it for a while, let's say, and you're going to renovate it, you can do the accelerated depreciation on the renovations. And or possibly, depending on how long you've owned it, you can do it for the base building that you start with. Purchases of existing property. So if you're going in and buying a property now or next month or 6 months from now, you can do a cost seg on that building. We do work all over the country. In New England, we're doing work on buildings that are 250 years old, some of them. And it's amazing, but the depreciation clocks reset every time somebody buys it from the prior owner. Buildings that were purchased or constructed since '87. As a technical point, you can take this concept, if you've owned a building that you or let's say your family bought in '88, you can step back to '88 without amending your tax return and grab the depreciation you could have taken, and you get to take it now. Typically, you won't go back that far, but as a technical point, the correct answer is you can go back to '87. You typically won't go back that far because this whole move, called cost segregation, is your accountant would say it's just a timing difference. You're going to get the same amount of depreciation either way, you just get to take it sooner. But if I ask most of you, would you rather have a deduction today or in 27 and a half years? Most people would say, I'd rather have a deduction today to save the money now versus 27 and a half years. So we're giving you the ability to take it now and do something else with it. So for that reason that it's a timing difference, the window of real opportunity is any building that you've bought, built, or improved in the last 10 or 12 years, and you've put into it somehow, some way, more than or near 500 grand. If you have multiple properties, you can stack them up and get to that number. Inherited buildings. So many people, you might know folks you might know folks that have owned a building, it's been in their family forever. Maybe you've known that person since you went to kindergarten, maybe your kids play soccer with their kids, or whatever, you know the family. And the building's been in the family forever, and you're thinking, that's not an opportunity for anybody. Well, it is, because what you are not remembering is that 6 years ago, Generation 1 passed away. Generation 1 passed away, and that property then went to Generation 2 in what they call a step up in basis, and that gives Generation 2 the ability to reset the depreciation clock, or it's not the ability, it's what just happened. So now all of a sudden, Generation 2 can do a cost seg on that building, save themselves a bunch of taxes, and maybe go buy another property with you folks. It's all about making the sale to other folks there. So what you're getting out of this is increased depreciation in the earlier years, and it's reducing your income taxes, which gives you better cash flow. And that's where I was saying, even if a property itself doesn't look like it's going to cash flow properly, with a cost seg in hand, it might become much more attractive. It could also theoretically help you pay a little bit more for the building, that somebody who doesn't anticipate the cost seg benefit, they wouldn't go as high as you can because you know you're going to save income tax on this. If this, by the way, I don't know that I get to this on this set of slides, but if it creates for your own situation a bigger tax loss than you can use in the current year, it rolls forward in what CPAs would call a loss carry forward. So maybe your tax liability is only 80 grand, but the cost seg just saved you potentially 100 grand of income tax. Well, but your tax liability was only 80 grand. You're going to carry that 20 grand forward into the next year as kind of like, and the CPAs have a heart attack when I say this, it's kind of like a gift certificate in your back pocket for the next year's taxes. They don't like it when I say that, but that's kind of what it is. And I said kind of, it's not really what it is, but it's kind of like what it is. So when you sell the property, it can create permanent tax savings because some of the assets that we reallocate are going to you're getting to take the deduction at ordinary income tax rates. And when recapture comes back into play, you're getting it out at capital gain rates. So there's whether you do straight line depreciation or whether you do accelerated depreciation, recapture is a thing that comes back into play when they're figuring out your tax liability on the gain. And when they do that, depending on the situation and depending on how long you've owned the property, you can adjust the way that's coming back in. The 15-year property is always going to come back as cap gain. The 5-year, depending on when you're doing it, you'll have a piece of that that will come back as ordinary. It's a messy, complicated conversation. Too much for this spot here. We can talk about it later if you like. Under what they call the tangible property regs, I know this is kind of tax geeky, and oh well, that's what you're hearing about, so it's tax geek stuff. But when you remember those whole things the IRS said are mandatory part of the building: the roof, windows, doors, HVAC, siding. Guess what? None of those items are going to last 27 and a half or 39 years. But you just bought the building, and the IRS says you got to write that off over 27 and a half years. So let's say our report identifies that you've got 100 grand, 50 grand, I'll go with 50 grand. Let's say the IRS or our report says you've got 50 grand in value of the roof. Well, the roof isn't going to last 27 and a half years. But it's 50 years divided by 27 and a half. 10 years in, you have to replace the roof. New roof goes on the building. The new money you spend, let's say you had to spend 75 grand to fix the roof. And this is a big roof. So now you've got to put the 75 grand on the depreciation schedule at that time. And at that moment, you're writing off 2 roofs. The one that came with the building, and now your new one that you just put on. Okay? That's tax inefficient, and the IRS doesn't force you to do that. You can do something different. If you've identified what the value of that original roof was, you can then take a write-off of the undepreciated part of it. In other words, remember, you've only written off 10 years of a 27-year item. That means you have 17 and a half years of that 50K to take as an immediate loss. In other words, it's an immediate write-off. So when that old roof lands in the dumpster, you get to take a write-off on it. Okay? But you have to have that value attributed. It also applies to windows. A lot of the buildings you're buying probably have drafty windows, and you're going to replace them. Probably siding might be one of the other things you fix up. Or HVAC. HVAC is another big one. So when you're doing your renovations, if you have a base, it can make sense to do a baseline study of the building that you bought, almost the day you bought it, and put values on everything. So that when you do your renovations, you can take write-offs under the tangible property regs that allow you to get another bite at that tax apple. So you get to take write-offs as assets are replaced. And that doubles or triples the value of the cost seg. There is no amended return required. As a matter of fact, the IRS says you shouldn't do an amended return to take advantage of this. So what you can do is use a change in accounting method form. So it's called a 3115. Again, that's tax geeky, but 3115 is the form that is used. You get to take all of those savings in the current year, so you don't have to spread it out. You get to take them all right now. You receive an extra 30 to 100% if you bought anything and or constructed anything since 9/11 of 01. And right after 9/11, the real estate market and the construction industry went into the tank. And as an incentive to get the economy moving again, the IRS and Congress put out an incentive item called bonus depreciation. And they said, hey, if you folks do any kind of new construction, you get to take accelerated depreciation on the new construction items if they've been contracted after 9/11. So at first it was 30%, and that wasn't stimulating the economy enough, so they moved it up to 50%. And then in 07, 08, they moved it up to 100%. And that was for new construction only, though. And that was around until about 2017 for new construction. It's still in place today for new construction. But in the Tax Cuts and Jobs Act of 2017, they said, hey, wait a minute, we're going to give an incentive if you buy an existing building, you get to take that 5-year, 7-year, and 15-year stuff. Instead of waiting 5 or 7 or 15 years to take it, you get to take it all in the first year if you want to. So if you close on a building on 12/30 of, let's say, 21, you close right on the end of the year. Your depreciation under straight line, under what the IRS would normally have you do, would be like a couple of grand. But if you did a cost seg on it, you can grab all of that bonus depreciation, all of that 5, 7, and 15-year item in the first year, even though you only own the property for 2 days of that year. So it's a huge deal for acquisitions of properties. We'll do an analysis. We've got that database of 20-some-odd thousand studies. So what we do is take information in from you folks. We'll turn around an estimate of tax benefit, number one, and also a fixed fee quote, so that you'll know before anybody spends a nickel, possibly even before you buy the property or before your client buys the property, you'll know what the tax benefit is going to be and what it's going to cost to get. And you can decide if you want to proceed with the cost seg or not. Again, usually if you're somewhere north of 500 grand, it'll make sense to do. It's real basic information. If you've got the listing sheet or an offering memorandum, we need address so we can Google Earth it, number of units, number of tenants, date placed in service. In other words, what day are you going to buy? Roughly what day are you going to buy? You might say May of 2022. The tax depreciation schedule or the HUD closing statement if you've already got it, and or the appraisal if you've got that, just so we have as much data as we can. Here's my contact information. I tried to make it go quickly. Fortunately, Thor cooperated with me here and he didn't get too out of hand. Have I bored you to tears? Nobody's thrown anything at me.
No, Jeff, thank you so much. Before we get to questions, so I know this seems like an advanced topic, and if I had heard that just a year and a half ago before we met, I probably wouldn't have known what you were talking about either. But you have got, if you're going to be serious about real estate investing, you've got to understand this tool, because it is incredibly powerful from a tax savings perspective and a wealth generation tool, as Jeff has mentioned. And I want to give you one example. I'm not certain that example number 3 wasn't our building, because the numbers look awfully close.
Dude, we got more depreciation than that.
But I want to give you
I told him to.
I want to give you a real world example that not from Jeff, but we partnered with Jeff when we bought our property in Lowell over in June of 2021, and we paid $20 million for it, and we raised $5 million from investors. We did a cost segregation study with Jeff. He did exactly what he said. Before we committed to the project, he ran the numbers, kind of gave us some estimates, fixed price offering, We went ahead and did it